Hi, good evening, and welcome to each one of you who have joined today's webinar. Thank you for taking time out to attend this session. Before we go ahead and start today's session, I would request each one of you all to just drop in a chat message in terms of what kind of experience do you have in technical analysis. Are you a beginner, or are you already an advanced trader? So that will help me identify, where I can start off the levels from. Basically, the webinar that we're going to be having is going to cater to both beginner as well as advanced technical analyst. But the idea is to make sure that we keep it simple so that we understand the indicators that we'll be learning today and how you can implement. Even if you're an advanced technical trader, how probably this might be an additional indicator that you can utilize to confirm any trading or investment activity. So let's just take the next 20-30 seconds to write down in the chat what level of experience do you have as a technical analyst, or are you very, very new to it? So if you're a beginner, you can just type in beginner. If you are advanced, you can type advanced. The session will be benefiting both of you all. So not a worry if you're a beginner also. All right. So I've got most of them are beginners, so that's good. So we'll keep the session very simple to understand, and the objective of this is to identify investment or trading opportunity in the market and how you can utilize technical analysis to achieve those targets. Now, at the end of the session, if you like the webinar and if you felt that I've done a good job in my explanation, and you have any good reviews for our webinars, please do go to Google and give us your review for Century Financial. And also, you can also by the end of the session, you can put in your comments as to if there is any specific technical indicators, or if there is any specific topic that you want us to cover. We can get an expert from those topics to come and speak as well in the next couple of sessions. For today, we will be looking at technical analysis, and we'll be looking at a couple of indicators that will help us identify good trading opportunities or good investment opportunities. So for those of you who are very, very new to the markets, there are two types of analysis investor or a trader does. That is the fundamental analysis, and the second one is technical analysis. Fundamental analysis is basically, to give you an example, let's say I'm looking at a stock like Apple, and I'm going to be doing a fundamental analysis. I'm going to be looking at their revenues. I'll be looking at all their earnings that have come out for the last 5 years, or probably for the last 4 quarters, depending on what I'm looking to invest and what time frame I'm looking to invest, to see fundamentally if the company is a good company to be putting my investments into, and to understand how their revenue has been working, and moreover, what is their future prospect as a company. Does it have potential to grow more in the next 3 to 5 years if you're a long-term investor? So this comes under fundamental analysis. Now, although we know Apple is a very good company to buy, but when do you decide what price is the best price to buy? Now, this you can do a lot of other analysis as to see which is the best price to buy Apple, but a technical analysis will always give you a clearer picture of how the price action for Apple has been for, let's say, the last 10 years, or the last 5 years, or even the last 2 weeks, depending on the time frame that you're planning to invest. Now, you look at the particular trend in Apple, and you identify and you see investor behavior. And every time Apple drops by a certain percentage, it might be a good level to buy purely based on technical analysis. Now, this has nothing to do fundamental in fundamentals. When you're doing technical analysis, it discounts all fundamentals. You're just looking for a good price to enter. Of course, however, if you're a long-term investor, you need to combine both of it. Of course, even if you're a short-term investor, you should have a bit of analysis done on the fundamentals for the company. For example, let's say you're a very short-term trader, you want to buy and probably sell it within the day or two. you still need to look at what is happening fundamentally to the company before you take those investment decision or a trading decision. So to be clear again, technical analysis, you look at the past historical price action that has happened, you look at the statistical trends that has been taking place, you identify a few trends, you see, you back test it, and then after that you can make an informed decision whether to invest or whether to trade in that particular instrument and at what price to be trading at. Now technical analysis will also give you a good understanding as to after you invest, how much can you expect in terms of returns. Now probably a lot of mistake that a new trader usually does is you enter into a trading you enter into a trade or you enter into an investment, but most of traders or investors might pull off once they see a short amount of profit, whereas probably let's say the trader was seeing a profit of 0.5% or 1% on a short term, and you close the position, but if he had to hold on to it, probably he would have got 3% return. So now technical analysis helps us even find solution for those kind of problems, so that we have complete discipline in every trade that we do. We stick to the discipline, which is very, very important, especially if you're a trader and of course, even if you're an investor. Now let's move forward as to what all we'll be covering for today. As per uh, uh, as per your registration, you would have seen that we'll be covering RSI and MACD today, but I would not be getting into MACD today, probably because it might take a little longer time, and the market has been very, very volatile. So I'm going to be keeping this very short with the RSI indicator, and with the RSI indicator, I'll also be showing you ATR indicator. Let's move forward. Now, what is RSI index or RSI relative strength index? What does it do? Basically, RSI is a technical indicator which is an oscillator, right? So, when you hear the word oscillator, you know it swings between two positions. So, I will show you practically how an RSI looks on the chart. If you're very, very new trader or an investor, do not worry about how the computation of RSI goes behind it. You can always do your research on that. But for now, I will show you how an RSI looks and how you can use it to identify good entry points, at the same time good exit points as well. Now, one thing that I would like to make a note over here is when I talk about exits, not every trade is going to be a profitable one, because market keeps changing depending on current scenarios. I'm sure most of you all know there's Russia Ukraine issues that is going on. On the other hand, we know that the Fed is planning to raise the interest rate, so there is a lot of news flow that is happening throughout the day, which can keep changing the swings in the market from both up and down. Now, this is where the discipline comes in, and at the same time, this is where our technical indicators also help us to manage the risk. All right. So let's look at how an RSI looks. Definition wise, RSI is a momentum indicator. It shows you the momentum used in technical analysis that measures the magnitude of recent price changes to evaluate overbought or oversold conditions. I will show you a couple of examples so you will understand what an overbought or oversold condition might look like. Okay, RSI is displayed as an oscillator, which we discussed, and it moves between 0 and 100. Right? Let's look at how it looks on the platform. If you already have a platform, I'm sure you're used to using this platform. If you haven't, please contact your sales representative and ask them to give you a demo account so that you can go through the platform and you get more familiar with all the tools that is there in the platform, and you'll also learn how to execute trades on a demo platform. Now this is a chart of SPX 500. For those of you all who are very, very new, SPX 500 is S&P 500 top 500 stocks of US put into one index basket. So instead of buying 500 individual stocks, if you're looking at investment in the US markets, you can always consider buying the S&P 500. Now, as I'm going through, if you all have any doubts, please keep putting it in the chat and I will try and cover as many questions as possible. So now we are on SPX 500 at the bottom, you see, you click on technicals, you go to technical analysis, the below bar opens up for you. And on the left hand side, you have two overlays and studies. We are getting into studies. You click on studies, then you find RSI over here. In case you're not able to find RSI, you have a search button on the left hand side. You can just type RSI and you should be able to find this. Now, once you click on RSI, the bottom part of the chart opens up with the oscillator. And remember, we said RSI is an oscillator. I'll show you a couple more examples when we're looking at it on the live chart. For now, if you notice, we discussed it moves between 0 to 100, 0 being the lowest point, 100 being the highest point. Now, by default, RSI has overbought and oversold limitations at 30% and 70%, which again could be customized. If you are an experienced trader, you can customize it as per your backtested data and analysis to suit the best in terms of what gives you high profitability and in terms of drawdowns, which has the minimal drawdown. You can always tweak your RSI, and you do this when you backtest and see how RSI has performed for the last 1 year, for the last 6 months, for the last 4 hours, for the last 30 minutes. So you can always tweak it, and it also is very important to note the instrument that you will be using RSI on. We will not get into very detailed analysis of which time frame is best for what. Let's look at, we have all the settings which meet our requirements. How does RSI help you in making decision? Coming to that, you see every time it has gone above the 70% mark, it has gone into this blue zone, which you can see slightly over here, and it has started dropping back. Now let's look at what happened to the price action of that particular index. So the prices went up, and then you see the prices started dropping, it came down, and then at this point it starts recovering back again. Now looking at RSI, you understand when it is oversold that buyers would be present in this area to buy it back, and vice versa. When it is overbought, there might be sellers in the market who will be looking to book profits, and also short sellers who are looking to sell and make a return on the short side of the market. But does it look as simple as this on a day-to-day chart? Not every time. We have to look at the drawdowns of an RSI also. It is not a trade that gives you simple signals where you just buy and where you sell depending on RSI. And RSI can remain in a oversold region for a very long period of time where the market continues to tank. So these are few drawdowns that you will always need to keep in mind. But keeping in mind, we should not be scared of that. We will have our risk management techniques to counter in case the RSI continues to remain oversold and the market continues to drop. This is where the risk management comes into play. Now, moving forward, the next indicator that we'll be looking at is average true range. Basically, average true range is a technical indicator that measures the volatility of an asset. In simple words, let's say you want to find out how many dollars can gold move in a day. And let's assume that you're looking at the gold prices for a short term trade. You want to know if I buy gold or if I sell gold. Let's say if you want to buy gold at this very minute, we are the time right now is 4:15, and I want to know in the next 15 minutes how much gold can move. If I have all the indicators that is giving me a signal which is showing that the prices of gold can move up, but I want to take the trade. At the same time, I need to know what time frame I'm taking this trade for. If I'm taking it for a very small move, that is probably next 15 minutes to next half an hour, then I need to understand how many dollars does gold move in a 15-minute time frame. And that is where ATR helps us. It will show us how many dollars can gold move in 15 minutes, how many dollars can gold move in 30 minutes, in 1 hour, in 1 day, 1 week, and a year. So let's look at a couple of examples on that as well. Yeah. So again, same chart, go to technicals, go to studies, and you find your ATR. right? In case you do not find this, you can always go to the search button, type ATR. You will get ATR stands for average to range. Now once you click on ATR, again at the lower end your technical indicator opens. Previously we had RSI, right now we have the ATR. You can have multiple technical indicators at the bottom that is open, depending on the indicators that you very often would like to follow. Now let's look at ATR on S&P 500. Things to be noted: I'm looking at S&P 500, that is the index. I am looking at a time frame of 1 month. So what ATR tells me is how many dollars can SPX move on a monthly time frame, right? So if you look at it back in 2005, the average range was roughly about $80, right? And as we've come into 2020, 21, and 22, you see the average movement of SPX has gone up much higher. Earlier it was $80, now it is $230. In simple words, if I buy SPX this month, how many dollars can I expect SPX to move? It can move about $236, which has increased actually. In fact, now I will be showing that on the live chart. Now, one point to be noted on ATR is ATR does not give you direction in the market. It only shows how many dollars, how much of volatility can we expect in a given instrument in the given time frame. Now, SPX, can it move $236 as per ATR? Yes. But does it necessarily have to move up? No. It can also move down by $236. So now, if this is the case, why are we looking at ATR? That I will show you when we do our trades on the live platform right now, to understand how ATR helps us to make decision. Moving forward, we'll be looking into RSI. Now we are looking into ATR. Now we've come to the divergence. Now, keeping RSI in mind, divergence are something that you see when you see the pattern between the way the stock price is moving or the price of the instrument is moving versus how RSI is moving. Now we do understand that RSI shows the momentum and it is an oscillator, it goes up and down, whereas the market can just continue going up and RSI can still be oscillating between both the 30% and the 70%. So here you find two kind of divergence that can happen. You might find the markets are going up, whereas the RSI is gone up but not in tandem with the markets. In fact, RSI is coming down while the markets are going up. So now these are some divergence that appear when you look at the charts. How do you take advantage of this divergence? I will show you now. Let's look at two types of divergence that we have. There is a bullish divergence and there is a bearish divergence. You have a bullish bias as well as bearish bias. Now within the divergence, there is also a regular divergence and a hidden divergence. Most traders look for a regular divergence. Of course, you also find hidden divergence, which will give you an indication. I will show you what these two mean and how you can use those to find opportunities in the market. Now, of course, both these divergence have a bullish view and has a bearish view. Bullish view meaning the market can go up, bearish view meaning the market can come down. Let's look at a regular divergence. So basically, a regular divergence is used as a possible sign for trend reversal. So the key thing about regular divergence is where you're looking for a reversal in trend. For example, yesterday the market started dropping and we had to wait to identify when is the ideal time probably to get back into the market. So you're trying to identify a reversal in trend because the markets were dropping, but you're looking for an opportunity to buy it so that when markets go back up, you gain because you bought it at a lower price. But how do we identify which is the best price, which is the bottom? It is practically very impossible to catch the bottom, but you can always try and use the technical indicators to analyze the market and try and find a suitable bottom that you can enter on, and of course with all risk management in place. Now if you're looking at a regular divergence, it shows you trend reversal. That means if the signal is bullish, Prior to that, you would have seen the market dropped and you're getting a bullish signal, and bearish vice versa. I'll show you an example. I think this would give you a much better picture. Okay, if the price now, for those of you all who are not very familiar with charting, do not worry about it. I will take you through the charting quickly as well once we go to the live platform. For now, instead of the candlesticks, I have just made it a line chart. You can change the different type of charting as well on the platform. Now if you look at this is euro USD on a 4-hour time frame. You see it is making lower lows, right? If the price is making lower low, when I say price, we are talking about the price of the instrument. Okay, if the price is making lower low, but the oscillator, what is our oscillator in this? RSI is our oscillator, is making higher lows. So basically, if you see the lows of these points are not coming back down the way markets are moving. Ideally, you see markets moving in tandem. Like if you look at this particular level over here, you see the market came down. Sorry, you see the market comes down over here, but you see RSI also following the same pattern. Okay, if you look at the lows at the lower end, the lows and the lows of this particular drop, both are in tandem. But let's look at what happened over here. Here, the markets are still dropping from the upside. The lows are being made, the new lows. When I'm talking about lows, I'm talking about the price coming much lower before it jumps back up. Again, it came, made a new low, jumped back up. Again, it came down, made a new low, jumped back up. Right? So when we talk about lower lows, that is what we mean on the price, and higher lows on RSI. You see, market went up, and when it came back down, while this made a new low, this one did not. This one hardly came down. It did not go below this low. So you see a divergence. Market is behaving in a different direction, whereas your RSI is behaving in a different direction. So what does this translate into? Yes, the market is negative, but the RSI, remember, RSI shows the strength in the market. The strength of the sellers are basically weakening out, whereas the buyers in the market are dominating it. So basically, we see although the prices have been dropping lower, we know that the buyers are pushing it back sharply. Now, this gives us an indication that eventually the price of this particular instrument is going to go up. Why? As per RSI, buyers are pushing it back up with much more strength compared to what is happening on the price reaction. And then you see a breakout, you see this upside move. Now, I know this looks simple on historical data. I will also show you how we can apply this on the real-time data with stop losses and take profit. Yes, could this fail? It definitely can fail. It can continue going down, and then eventually RSI can come back in line with the markets. So you always have a drawdown. Not everything's going to be perfect every single time, but this is where the risk management comes into place. Now let's look at a bearish divergence. Pretty much opposite of what we just saw on bullish divergence. In bearish divergence, we are seeing the market going up. So basically, every time the market drops, it makes a new high. Market drops, it makes a new high. Now let's see if RSI is doing the same. No. Every time the market drops, RSI comes back up with the market, but it is not going above the previous high. So you see this is sloping down, this is sloping higher. So there's a divergence over here. Now, why is this a bearish divergence? Because we are looking at a bull market, which is where a market is only going up, whereas RSI is showing signs of the upside coming to an end. Now, few points that you can keep in mind is every points that you connect on this trend line up and down, if there is minimum 3 points that is connected, that gives you a higher indication to enter. If it is happening for the very first time, that does not mean that it would be the right time to enter. You should always wait for 2 to 3 different signals, and always not depend on one single technical indicator. Now, yes, if we have identified this on RSI, we found the divergence. Please also adapt few other technical indicators, probably a Fibonacci or a few other oscillators like a MACD that will give you a double confirmation, or moving averages that can give you more confirmation in terms of taking a trade decision. never depend on one single indicator. But as of for today, for the lesson that we are learning is on how, if we identify on RSI, what could be the impact of it depending on the divergence that is seen here. Now let's go to, okay, the regular divergence is best used when trying to pick tops and bottoms. So anyone who's trying to pick the top to short the market or to book the profit, or vice versa, anyone who's trying to pick the bottom so that he can buy at a lower price, and when market goes back up, you make profit. So far, I've not received any questions, so I'm guessing everyone is with me. Let's look at the next one, hidden divergence. Pretty much vice versa of what we just saw on regular divergence. Again, divergence not only signal a potential trend reversal, but can also be used for a trend continuation. Now, as in the previous examples, we saw that we are trying to take contra to what is happening. So if the market is going up, we are waiting for a good time to sell, or if the market is coming down, we are trying to take the lower price to buy it so that we can make profit when the price goes back up. So you're going against the market trend. Now with the hidden divergence, you can find opportunities to go along with the market trend or continuation of the trend. So as the word goes, trend is your friend. So for a lot of people who want to go with the trend, this is something that you can look into. Pretty much the same what we saw, but slightly different in terms of the movement. Now we are going with the trend. Now if you notice, the price of the market is going up, and we are trying to identify, when to buy it back. Now, same thing, vice versa over here. You see RSI, although the market is going up, but the RSI is coming to a very oversold region, meaning at this point of time, the market is showing a lot of strength back upside, and we are at an oversold region. So, chances of the markets going back up could be higher because of the divergence that you see over here. Vice versa, on a hidden bearish divergence, you see the markets are dropping, but RSI is come to overbought, meaning buyers are getting exhausted. So at every rise in the market, you can potentially look at taking a short so that when the market goes down, you make profit. For those of you who are not familiar with short selling, we will have other sessions where we explain about what short selling is. Right now, for now, do not worry about what short selling is. Just learn which direction can the market go to, and if we need to identify and pull out those points, what indicators can help, which is RSI right now, which we are looking into. Now, let's wind up the session on the theory part of it and try and do a couple of practical trades and see how to implement those trades. Most importantly, how to manage your risk while we are taking the trade. Now, key takeaways, keep in mind that regular divergence are possible signals for trend reversals, and hidden divergence signal for trend continuation. So depending on what kind of trader you are, you can look for signals based on whether you want to go with the trend, or if you want to go against the trend and find the lows and the highs to take a buy and a sell. Again, regular divergence equivalent to signal possible trend reversal, and hidden divergence signal possible trend continuation. Let me just share my screen. Okay. Is everyone able to see my screen? All right, perfect. So now we have S&P 500 again. We are looking at the same index. Now let's start from the beginning. Let me just close all of this. You see the RSI. Just make this. All right, so this is your chart. Now to keep it simple for everyone, let's just look at an instrument that we are all familiar with. Let's look at Apple. I'll keep SPX open as well. All right. Now, if we go to our technicals, we find our indicators. I'll make it easy. Search button RSI. Click on RSI. You get your overbought, oversold region, right? Now I'm looking at Apple price momentum. You see, Apple has gone up. It has remained on overbought. Apple has come down. It has come to oversold region. Right now, this is the basic of what we initially looked at RSI for overbought and oversold position. Now, let me also open ATR along with this. All right. So now we understand that RSI. Let me RSI oversold, overbought, overbought, and oversold. All right. Now let's say if we had to just follow RSI and you had to take a trade on Apple, let's say we are looking at a short-term time frame. Now we look at these signals to see where where the conditions are overbought or oversold. At this point, we were oversold. Again, currently we were oversold as of yesterday, and right now the prices have come up. Markets are closed. Now, if once you identify your oversold position, what is the next step of action? Let's take this as an example. Let's say you're an investor, or sorry, you're a trader who wants to take a very short-term trade. You want to buy Apple worth $10,000, and the price at that point of time, this blue line that you see, was somewhere roughly over here. Okay, I'll just mark that. RSI was at oversold. Sorry, RSI was at yes, oversold at this point. So you're looking to buy back because you're getting a much cheaper price on Apple, and then the market jumps back up, right? Now, in this case, let's say we know that market went up, we would have made a profit. But let's say we are in a situation where you do not know where the market is going and you still have to enter. And how many dollars are you going to keep your take profit on? That is where your ATR is going to come into place. Now, if you look at the average movement of Apple on a daily time frame, keep in mind that ATR shows us how many dollars an instrument can move in that given time frame. So I'm looking at a daily chart. So I know on a daily time frame, Apple can move about $4 to $5 a day, right? So what I do is I look at take profit. I'll be buying it at 158. Keep a take profit of $5. Okay. Where do we keep a stop loss? Keep a stop loss of $5 lower. Okay. Now the risk is 1:1. Of course, depending on the time frame and how long the market has dropped, you can always keep a double of your price. Let's say you keep a double of probably $10 on the higher end. So now, why is this more than the take profit? Let me close the take profit. The stop loss is very, very important for us. The fact that Apple can move $5, we should make sure that we have minimum $5 as the stop loss after our entry on a daily time frame. Reason being, if you keep anything too close or anything too far, is just going to take you off guard when it comes to risk management. Let's look at something similar that has happened earlier where it has failed. Let's look at RSI at this point where RSI is overbought. Now, if RSI is overbought, we expect the prices to go back down. So let's take a trade on RSI. You'll be shorting the trade. For those of you who are not familiar with shorting the trade, do not worry. We are looking at a trade where if the prices drop down, we make money. If the prices go back up, we lose. Right? So let's say you invest $10,000 again in the market, and we look at the ATR. Let's look at the ATR at that point of time. When RSI was overbought, ATR at that point of time was roughly $2.7. You can see on the right hand side, it was about $2.7. So about 300 points, that is $3, is where your stop loss is going to be. And let's say we are looking at 1:1 risk reward. You keep a take profit of $3 lower. You can even make it $5. So in this case, let me zoom this in. Right, we are taking a sell position at this price. Okay, that's not marking. You are taking a sell position at this price because the market is overbought. Okay, and then you keep a stop loss above it of $3 because ATR is giving you roughly $3, and you keep a take profit below that of roughly 500, sorry, $5, that is 500 points on our system. Now in this case, what you notice over here is this particular trade also came into profit. But if you look at the very next trade, let's say again when it went back up, you take a sell pretty much around the same price. Okay, you take a sell, and if we did not have the stop loss, let's remove the stop loss. Let's say if we did not have the stop loss, this went back drastically higher. So in the case where we wanted to risk about $160, you ended up risking almost $1,400 on this trade because it went against us, although RSI was overbought. Now, why I showed you these examples is if we had to stick to discipline, we would have had a loss of 120, $140. But because we did not keep a stop loss, let's say Apple went against us, and currently we are losing about $875, almost $1,000 loss on a $10,000 account value. So what happens on one single trade? You ended up losing almost 10% of your equity just because we did not keep the stop loss. So the idea of using RSI is, yes, to get good indications in the market to buy or to sell. But I would always recommend that do not use only RSI, use at least 2 to 3 different indicators that will help you identify the trend. At the same time, use your ATR to always have risk management in place, because if you do not have any stop losses, you do not have any take profit, you end up losing more. And when you do not have strict take profit that is kept, probably you take a trade on Apple gives you hardly $10-20, you book the profit where you could have potentially made about $200 when it came down. So ATR is important for you to identify how many dollars of take profit or stop losses to keep. Right? Any questions so far on? Do you want me to repeat what I just showed you again? We can do that. Is there any specific instrument that you want to see me do this on? I can show you that as well. Let's till you'll write in the chat, I will just look at SPX. Again, why I'm showing you SPX is SPX is the benchmark of US markets. If you want to know how the US market has been performing, let's look at it from a longer time frame. You see this all the way from 1996, and this is where we are at current markets. You see the 2008 crash, you see the pandemic drop, and right now geopolitical tension and interest rate hike, we see the markets are dropping. Now markets are dropping, yes, but is it an opportunity to buy today? Absolutely. Is Ukraine and Russia war going to bring more chaos into the world or into the global stocks? Yes, it could, it may. It might ease down by the end of the week, or it might become even more worse. Now, that is the fundamental of it. We know that is what is happening in the market. But let's leave all of those out. Let's just look at, I'll open Apple again, individual stocks along with S&P 500. Now, if you look at Apple again, all the way from 2009 to where we are at right now, you will notice that there is always a pattern that happens in Apple. Now, you see this drop on Apple over here, 36%. That was a big drop there. You see again Apple drop, 34%. Then you see again Apple drop here, 24%. You see another drop that came into Apple over here, about 20%. And you see this drop currently that is about 16%. So now what do we understand from this is, on an average, every time Apple drops anywhere close to 20-25%, then it is a good time to invest. Remember the first part that we discussed about how technical indicators help us identify which are good levels. Now, is Apple a very good company? Yes, it is a good company to buy and hold. But can we buy Apple right at the top? Probably no, it's better to avoid, so that you can wait for a drop in the market so that you can always buy back into Apple. Now let's look at similarly on SPX. Now we see SPX, this was the drop that we saw in 2008, right? That was the recession, that was about 58%. I'm just going to be changing the candlestick to a different candlestick. I'll not get into this. It's called Heikinashi. It's basically a trend. It shows you the trend in the market. So I'm just going to change it. Just keep your eyes on the candles. Yep. Now, can you see the difference? You see like where the trends have changed and where the trend has continued. Now we can measure all the drops in the market. And this big drop over here was, of course, the pandemic drop. Now, apart from a recession, you see whenever there is a drop of again 20%, pandemic is one of event, which is about 35%. Now let's look at where we are today. From Jan till now, the markets have dropped roughly about 15%. So if you had to look at this, leaving the noise out, probably buyers or investors, if you're looking at the long-term investment buy and hold, yesterday was a very good buying opportunity when there was chaos going on the other side. Let's look at a daily candle of what happened yesterday. You see that the market dropped, and yesterday when the closing happened, the markets came back up. Who pushed these prices back up while there was a war going on in Russia? These are levels where all the investors always keep an eye on, and they do their analysis using technicals, using all the statistical data that they get from the past to identify good levels of entry. Now, can the market go down much more lower than this? Yes, it can. How do we analyze that? We see previous drops. Whenever there was a pandemic situation, you see a drop of 30-35%. Whenever there's a recession, you see a drop of 50-56%. On an average, every other drop that you see, which is a normal drop, either because of geopolitical issue or due to because of change in policies like interest rates increase or interest rate decrease, you see on an average it drops about 20 to 16 to 20%. Now, of course, we got a 15% drop already. I'll just make this precise. About 15%. Now we all know that next month the Fed is going to be raising the interest rate, and they could possibly rate much more. Increase much more rates during the year. Now, keeping all those factors in mind, even if you did buy something yesterday, always be ready to see another 5% more drop, because on an average we have seen 16, 18, and 20% drop earlier, right? Now let's come back to technicals. Let's put our RSI and see what RSI is telling us. Daily time frame. Okay. So two things that I can see instantly on RSI. One is the bullish divergence, lower low. Okay. Ideally, they should be making lower low to RSI, but it is making a higher low. So one indication of buyers present because the market is showing signs of strength. So every time now it drops back down, it is a buying opportunity again. Depending again, when I say buying opportunity, please be very clear with the objectives. Are you looking at a daily trade or are you looking at a long-term trade? Anybody who looks at a daily chart usually is having a view of 1 week to a month from now. Anyone who is looking at a smaller time frame like a 30-minute chart is having a view just for the day or maximum 2 days. Now looking at daily, we understand this has given a bullish divergence. We can expect the prices to go up. Yes. Now if we have to buy, where am I going to buy, and how am I going to keep my take profit? What kind of returns do I expect? Let's go to ATR. Okay, so remember the point that I said, a person who looks at a daily chart is always looking at a weekly view or a monthly view. Okay, now the ATR shows us that on a daily time frame, at this point in time, SPX can move about $98. Let me just make that bigger. Yeah, this is ATR. It moves about $100 a day. Now let's say I look at the weekly. On a weekly time frame, it moves about $160. Now, if I want to take a trade on, or if I want to invest in SPX 500 and hold it on for, let's say, a month or so, this is what we'll be looking at. Let's say again, $10,000 is how much I have in the account. I'm going to be investing $10,000. If you take leverage, please make sure that you always have stop losses and take profit. If not, the markets can be very, very brutal when it starts going against you. Take profit. Okay, now I'm just going to be closing RSI. Oh, sorry. Actually, before I close RSI, now we understood that every time the market gives us a dip again towards the oversold region, right? Or on this particular trend line is a buying opportunity. So let's say the market does give us a dip eventually during the day while RSI comes back down towards 4,160, 170 levels. Or let's keep it a little on the higher end. Let's say the market comes back down by 4,190. Now, how do I identify how many dollars of take profits or stop loss do I need to keep? Understand it moves about $100 a day. Okay, so I keep a stop loss. And on the upside, now I also know that in a week's time it can go about, let's look at RSI in a week's time, can go about 160. If I hold on for 2 weeks, probably it might give me a little more. On a monthly time frame, it can go about $300. Depending on my objective for this trade, I will keep a stop loss and I will also keep a take profit of, let's say, 250 points. So in this case, we have a stop loss set, $280, sorry, $238, and we have a take profit of $600, and which could again most likely trigger because all the other, like if you read candlesticks, this showing a very bullish signal. But we need to wait for a dip before you buy, not get onto the buy right now. The market is going up. You always wait for the signals, and those signals is when RSI again comes back towards the oversold region, and that is where you entered. Yesterday would have been the ideal entry point, but if I missed yesterday's trade, I wait again for it to give me an entry so that the risk reward works out. Let's say I enter right now at the market price. My risk reward is very bad, meaning the prices can come back down, hit my stop loss, and then eventually go back up. So it is very important to note that discipline is the key part of any analysis. We might have the best analysis in the world, but if we lack discipline, that is where 95% of traders lose money. One is over leverage. Even if you're taking a lot of leverage more than what you have in your account value, it's still fine to an extent where you have a stop loss mandatory. Let's say the max leverage that one would recommend or we would recommend is not more than two times your account value. And even on that, a very strict stop loss should be put. So for the day, I think we will have to wrap up for today with RSI, and probably the next session we will also cover MACD for you. But I hope you all understood the basics of how you can use RSI with the combination of ATR to manage your risk and reward, and of course the different time frames that you'll be looking at to make different investment objective. If you're looking at a 30-minute time frame, you're looking at an intraday perspective. If you're looking at a daily time frame, you're looking at a weekly or a monthly objective. If you're looking at a weekly or a monthly chart, you are pretty much looking at taking an investment for the next 1 year to even 5 years. So time frame does matter a lot. Each time frame things change. I'll just quickly show you how that does. Let's say ATR. Okay, we understood ATR changes on each time frame. Let's look at RSI. One point that I forgot to show you all. Now this is how RSI looks on a daily time frame. Let's look at RSI on a 5-minute chart. Now this is RSI on a 5-minute chart, right? Overbought, sell, stop loss, take profit. Again, overbought. Let's do the trade since we have the opportunity right now. We know it is overbought. I need to take a sell. So I'm going to take a short position. I have $10,000 in my account. Okay. Now, how do I keep my stop loss, take profit? I need to go to the ATR. I think there is some news that has come out, but we still take the trade purely on technicals. ATR is showing me that it can move about $10 on a 5-minute chart. Let's look at a 30-minute time frame, 13-minute time frame. Also, we see that RSI is coming to overbought, which moves about $20. So let's say you keep about $20 stop loss and you keep a take profit of, let's say, $40. Right? So we are taking a sell at current market price at 292. Stop loss at 309. Take profit at 250. I'm going to take the trade. Okay. So now this again is a trade that we have taken on SPX 500, and this is a live price. Now in this case, let's look at what would be my scenario. Market has gone up. I'm taking a reversal in trend trade purely based on RSI. I have not looked at the news. Probably if there is some news that has come out which is positive for the market, avoid taking a contra trade. But if there is no news, you can still take the trade, but make sure you keep your stop loss. So in this case, I will be risking about $50 to make about $100, which is a good risk reward ratio for a $10,000 account. Now, this is just one trade. Now, you can identify multiple trades on multiple instruments on multiple time frames to take these trades. Perfect. So I see that you all have not asked me many questions. So I hope I was clear with all the lessons that was taught today. If you all have any feedback or comments for me, please feel free to write in the chat. And also do not forget to give us your review on Google. It'll mean a lot to us. And if there is any specific topic that you want us to cover uh, in finance, any area, technicals, fundamentals, any specific type of investments, options, trading, portfolios, please do write in the comments so that in the future we can have those sessions for you as well. I hope this session was informative and you got to learn something new today. I would look forward for your feedback, and I will see you all again very soon in the next session that we're going to have. Thank you all for your time. Thank you for joining us today for the webinar. Have a good evening.